Hey, what's going on everybody? My name is Ryan and today we're going to do another video, a reaction video, based on, the things that I find on the internet, whether it's people asking silly questions or people giving what I think is terrible advice. It's a good way for us to cover a lot of broad topics in one short video, so here we go. First one is a screenshot of a text message that was posted in a tax professional group. The text says, "Hey, sorry to bother you when using QuickBooks and tracking mileage and invoice for payments. I know you don't have to claim cash, so we obviously can't track the mileage for those cash payments, correct?" No, that's not correct because you have to claim cash income and expenses. There's this idea that because you got paid cash, you'd have to report it on your tax return. And while it would be more difficult for the IRS to, audit you and prove that you made that income, it is still considered illegal if you withhold that information from the IRS from your tax returns. Okay, so any income that you earn, whether you're self-employed, whether you're W-2, if you earn it in cash, you should report it because that is earned income. Now, clearly, there's probably millions and millions of people not reporting that income. And, sadly, they may never be caught, they may never be found out, but still, as the law states, even if it's cash income, you have to report it. I paid over $60,000 in house payments over 5 years for my son to avoid foreclosure. I have bank statements to prove it. He recently sold the house and wants to pay me back. Will there be any tax implications if he gives it to me? The answer is no. There shouldn't be any tax implications if your son's just paying you back money that you lent him. Now, if you charge him interest, if you loan him money and now you're charging him interest, then you have to report the interest you earned as interest income. But, if you had lent him money or you just draft up a loan agreement, a loan contract that says you lent him some money, he's paying you back, any repayments of loans are not like a taxable event. If you did just give him the money, then there could be a taxable event that you're looking at, and we might look at the gift tax return, generation skipping return, that kind of thing. So if he's paying you back money you lent him, no tax return needed, no tax event. I have an LLC just with me and my daughter as an employee. I also have a W-2 job. I had to get glasses for both near and far vision changes. Insurance paid for some of it, but I'm wondering if I can write off the $467 because I need them to operate my business for computer work, driving to clients' houses, etc. No, glasses are a personal item and you cannot just write them off. This is same questions I get asked sometimes from realtors who buy their fucking Prada shoes, if they can write off their shoes because they gotta look fabulous for their clients, and the answer is no, you can't write off the designer clothing if you're a realtor because you gotta look fabulous. Same with glasses, they're a personal item. They're not for business, they're a personal item. If you worked at a gun range and you needed safety goggles, or if you owned a gun range, you needed safety goggles, that's a different story, because you're wearing those safety goggles at the gun range. But, glasses for your vision, that's not a business deduction. And no amount of mental gymnastics can get you there. Hello, question, how can someone with multiple rental LLCs not show these transactions on the Schedule E? How would reporting all the income from these multiple LLCs into a corporate entity or trust work out? Trying to figure out the best way to not show these activities on a 1040. Thanks. So this is a question asked in a Facebook group. And then down below, this guy responds, run the rentals through a separate entity, set up as a management company. You can then use that income, even create a 401k. You can't use Schedule E to contribute towards a retirement plan. Yes, now that is true. You can't use Schedule E to run the income to a retirement plan. But there's so much wrong with that advice, and also the devil is in the details. Okay, so to the original poster's first question, can you run the rental properties and take them off of the Schedule E on the personal return? You can't do that. You would have to put them under a corporation. And there's a lot of people out there that will say that putting long-term property, rental property in a corporation is not a good idea, just because for state tax planning purposes, let's say you put it in an S corp. Well, when you pass away and you own rental property, typically that property gets to step up in basis so that your heirs, when they sell it, they don't pay the capital gains. Well, you put them in an S corp, then you lose that step up in basis. And there's gonna be probably a ton of taxes associated with selling the property down the road. If you died, obviously. If you live, then doesn't matter, but chances are you might die. Pretty high you might die, but we don't know how likely you will die, in the near future. Now, putting the property in like a C corporation, that I feel like is even the worst idea, because you're paying taxes at the corporate level, and then you're paying taxes when you want to distribute the money to yourself personally. So typically, I just don't recommend putting properties in a corporation, like at least long-term properties that you're holding long-term. Now, for this guy's advice to run the properties through a management company, I don't know what he means by that per se, because running properties through a management company, there's no like specific legal ramifications for the word running. So first of all, if you want your rental income to count as earned income, then you have to meet certain criteria for the rental properties to not be considered passive income. So you have to spend at least 50% of your time working in real estate. You have to have a minimum of 750 hours per year in real estate. Okay, those are a couple of the criterias. And if you just have a few rental properties, you're likely not going to meet that criteria. So if that was your advice, buddy, to run them through a separate management company to get earned income to set up a 401k, that is not proper. Now, if you wanted to set up a management company, like an additional management company, and your rental property or you personally pays that management company a fee to manage your property, then you can do that. As long as the management company doesn't own the actual properties, okay? You still have to own the property, or a different entity still has to own the property. But as long as the management company doesn't own the properties, then you can do that. So what that looks like is, in this situation, let's say you want the properties off of the 1040 and you want self-employed income, you're gonna have to set the LLCs up in a corporation, first of all. And then you're going to have to run the management fees from the corporation to the management company. So basically, your corporation will probably report zero net income, and then the management company will show the net earned income for the management fees. But that starts to make things more complicated, and you're gonna have more checking accounts, more tax returns to file every year, and who knows what the reasoning is of trying to get these properties off of the 1040. Who knows? All right, last question. If you were to buy a rental property now at market highs and the housing market crashed a month from now, would you be able to sell the rental property to another one of your LLCs at the lowered value to claim the loss in value for a tax deduction? No, you can't do that. It's called a related party transaction. IRS has rules against this, where making up fictitious economic transactions to claim losses, even though you might still enjoy the benefit of having the property, you get to claim this loss. That's not a legitimate thing you can do. And the IRS actually includes certain levels of family members, as related party transactions. I think it goes up to like siblings and stuff, not just your wife or your kids, but I think it goes to siblings. If you sell to your siblings like that, it still could be considered a related party transaction. So the answer is no, you can't do that. Obviously, you still own the property, and you take a loss, a deduction. That would be ridiculous if they would allow that. So good ideas though, I think. But yeah, anyways, thanks for joining me. My name is Ryan again, and if you would consider subscribing to my channel, that would be awesome. I do a lot of these videos. I do a lot of videos on taxes and all that stuff to help educate you people, and hopefully you can learn something from this. All right, so that's all I got. Take care for now and stay safe. I'm in the mood for a switch up. I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that's a sticker. She picture perfect, so I told him I'm a flicker. Bill, I'm in the mood for a change up. I leave the city and return with my change up.